What are baby bonds? Baby bonds are small-denomination bonds with a face value under $1,000, aimed at attracting retail investors who may not have large amounts to invest in traditional bonds. Issued by municipalities, states, and corporate entities like telecom and utility companies, baby bonds help fund infrastructure projects or capital expenditures. Corporate issuers, including business development companies, BDCs, often use these bonds to raise capital for small and medium-sized businesses. Their lower entry point makes them accessible to a broader range of investors. One of the defining characteristics of baby bonds is that they are unsecured, meaning they are not backed by any specific collateral. In the event of default, investors do not have a claim on the issuer's assets, which increases the risk factor. Additionally, baby bonds are highly sensitive to interest rate fluctuations. When interest rates rise, the price of baby bonds decreases, which in turn raises their yield. This inverse relationship between bond prices and interest rates is crucial for investors to understand when assessing potential returns. A recent development in the U.S. regarding baby bonds involves a government policy aimed at reducing wealth inequality. In 2021, congressional Democrats proposed a bill to establish $1,000 baby bonds for every American born after December 31, 2021. These bonds, known as American Opportunity Accounts, would accumulate over time and could not be accessed until the child turns 18. This policy is particularly focused on benefiting lower-income families and aims to narrow the wealth gap in the U.S. Research from Columbia University and McKinsey suggests that baby bonds could significantly reduce the racial wealth gap, especially among younger adults, and potentially boost the overall economy by 4 to 6% of GDP. Despite the advantages, baby bonds do carry risks, especially in certain industries. Shipping companies, for example, are known for being inefficient and over-leveraged, making their baby bonds less attractive to investors. On the other hand, U.S. savings bonds, including Series E and Series I bonds, offer a more secure investment option. Series E bonds come with a fixed interest rate and are guaranteed to double in value within 20 years, while Series I bonds adjust their interest rate based on inflation. Investors can purchase these savings bonds electronically via treasurydirect.gov, making them easily accessible and manageable. In conclusion, baby bonds present both an investment opportunity for retail investors and a policy tool for addressing systemic wealth inequality. However, potential investors must carefully weigh the associated risks and benefits.